For the first time since early February, international crude benchmark Brent went below $90 a barrel last week. This level was last seen prior to Russia's invasion of Ukraine. The recent decline came amid expectations of weaker global demand and US dollar strength. Indian refiners have also been securing discounted supplies from Russia as sanctions prompted many oil importers to stop trade with Moscow. Russia rose to become India's second biggest supplier of oil. India too became Russia's second biggest oil buyer after China, although India's monthly oil imports from Russia have been declining after hitting a record in June. Only in August did Saudi Arabia overtake Russia by a thin margin to once again become the second biggest oil supplier to India after a 3-month gap. Between April to August, Russian oil accounted for about 16% of India's overall imports, compared with just a 0.5% share a year ago. Yet, Indian refiners are not passing on the cost savings derived from purchasing discounted Russian crude oil to the end users of diesel and petrol. Petrol currently costs 96.72 rupees per litre and diesel 89.62 rupees a litre in the national capital. If one excludes the impact of excise duty cuts in May, prices of petrol and diesel have been unchanged at fuel stations since April 6th for a record 166 days. Early this month, Minister for Petroleum and Natural Gas Hardeep Singh Puri had linked no revision of fuel prices to the losses that state-owned fuel retailers incurred in keeping the fuel prices unchanged when international oil prices surged to multi-year highs. Have we recouped all our losses? Puri asked. The three retailers, BPCL, HPCL and Indian Oil, posted a combined net loss of 18,480 crore rupees in the June quarter. At one point, oil marketing companies were losing 20 to 25 rupees per litre on diesel and 14 to 18 rupees a litre on petrol as international oil prices soared. These losses have been trimmed with the fall in oil prices.
If government would have allowed to increase the prices based on the crude price movement and the retail fuel prices would have adjusted accordingly, then we would have seen retail fuel prices going up substantially higher in Q1 and prior to that also. Government said that we will try to control the inflation by maybe not allowing the prices to move up. As of now, all three OMCs have reported huge losses in their Q1 performance. And this has happened despite the highest ever GRM of $16.7 per barrel. It is mainly because large losses on the marketing side. So they were not increasing the prices. That has helped India in controlling inflation to a certain extent, help the end consumers. So with refining margin declining, retail prices frozen, losses remain very high. So on the refining side, the Singapore complex refining margin had turned negative $3 per barrel. And that means they are incurring broadly on a benchmark basis. They might be incurring some losses. The overall scenario remains by and large the same. So definitely there has been some improvement as compared to Q1, but they are still not out of woods.
After Monday's fall in crude oil prices, Pokarna says OMCs are still incurring a loss of 8 rupees per litre on diesel, though this is down from 15 rupees in Q1 and 13 rupees in the ongoing Q2 up until last week. For petrol, the marketing margin turned positive yesterday to 6.5 rupees per litre. This compares to a negative 11 rupees in Q1 and a negative 3 rupees per litre until last week. Oil Minister Puri had indicated that international oil prices need to stay at $88 per barrel or below to bring some relief. Although there is no under-recovery on petrol now, for diesel it may take longer. As a prudent measure, OMCs will be allowed to recover the past losses before the benefit of any further fall in crude price can be passed on to the consumers.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.